They begin to reduce exposure, not in panic, but in prudence. Then, as those early moves compound, markets start to reflect the shift. Prices adjust, liquidity thins, and what was once considered safe starts to feel uncertain. The herd follows only after the direction is clear, amplifying the movement. Today, we are witnessing the early stages of one of the largest reallocations in modern history. For decades, capital has concentrated in financialized assets, equities, bonds, derivatives, driven by declining interest rates, globalization, and abundant liquidity. The post-1980s era rewarded leverage, speculation, and risk-taking because the system encouraged it. Every crisis was met with easier money, lower rates, and greater stimulus. Investors learned a dangerous lesson: risk was never punished for long. That cycle, which lasted nearly half a century, has reached its end. The forces that once supported financial assets are now reversing. The first reversal is the end of cheap money. For years, artificially low interest rates made borrowing costless and speculation rational. Capital chased yield wherever it could find it: emerging markets, tech stocks, corporate debt. But when inflation returned, it exposed the fragility of that arrangement. The entire structure was built on the assumption of perpetual liquidity and low inflation. Once that assumption broke, the capital that had inflated paper wealth began to retreat toward real wealth. The shift from financial assets to hard assets marks the essence of this reallocation. The second reversal is geopolitical. For decades, globalization allowed capital to move freely across borders, seeking efficiency in return. But in recent years, trust between nations has eroded. Supply chains are fragmenting. Alliances are shifting, and money is becoming political again. Sanctions, asset freezes, and currency weaponization have changed how large investors, especially sovereigns, think about safety. If reserves can be confiscated or blocked, then diversification becomes an act of survival. That's why we're seeing record gold purchases by central banks, especially in emerging economies. It's not speculation, it's strategic reallocation. The third reversal is structural. The developed world is aging, productivity is slowing, and debt is compounding faster than growth. These conditions make traditional financial assets increasingly unattractive relative to tangible or productive assets. Real estate, infrastructure, commodities, and resource-backed ventures are regaining importance. The new generation of capital allocators is beginning to realize that true wealth is not measured by nominal returns, but by purchasing power and durability. Massive capital rotation is rarely orderly. It unfolds through disruptions, crises, and moments of panic. But behind the volatility lies a rational process. Markets are repricing risk to align with new realities. The institutions that thrived under the old paradigm, banks, hedge funds, governments, struggle to adapt because their models assume conditions that no longer exist. They mistake liquidity for stability. But liquidity disappears when trust falters, and stability evaporates when the assumptions behind it collapse. What we're experiencing now is not a routine correction. It's a transformation. For decades, investors treated government bonds as the bedrock of safety. Today, those same instruments are sources of risk. Real yields have turned negative, not because rates are low, but because inflation is persistent. The supposed risk-free asset has become a guaranteed loser in real terms. This realization is forcing institutions to reconsider where true safety lies. And increasingly, the answer points toward scarcity, toward assets that cannot be printed, diluted, or defaulted upon. Gold, silver, energy, and essential commodities are becoming the new foundation stones of capital preservation.